All right, everybody. Ladies and gentlemen, hello and welcome to us here at Nadex. My name is Philip and I will be once again your presenter for today's webinar. Today, it's an introductory type of webinar. We want to have a look at spreads and understand what Nadex spreads actually are and how do they work. How can we trade them in today's market environments? And if you have a look at your webinar interface, you can see that small questions box. Right now, I would appreciate a very short yes or why in that box to just let me know that you guys can hear me well and that you can actually see those screens changing. Perfect. Everybody who's replying here, thank you very much. And guys, I hope this little exercise of typing in that box has taken away your fear, your intimidation of interacting with me. I would like that session to be as interactive as possible. We are here to learn something together. Please put those questions that you might have in that box. I'm more than happy to answer your questions. I'm really looking forward to that interaction with you guys. So please don't be shy. Today's webinar is scheduled to run for something between 30 minutes, 45 minutes, something like that. If you happen to have questions toward the end of the session, no problem at all. I'm happy to stay here longer and help you with those questions. Before we get started, we already have those first risk disclaimers up here. Please take a moment of your time to read through those and make sure that you're comfortable with them before you're continuing with the webinar. Essentially, this says that trading, of course, involves risk, and you should understand those risks and the risk associated with the instruments you're using before you are getting active in the market. That's a major part why we're here today. We want to understand risk of spreads and how we can trade those spreads. So if you are here to learn about the risk exposure of those instruments, you've definitely come to the right place. As neither Trade with Position nor myself are investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only. We will be looking at the live market in just a few moments. Again, it's just for educational purpose. I'm just illustrating some ideas that I might have and how we can trade that market depending on our market and assumption about what price might be doing in the future using spreads. It's not a trade recommendation. It's really there just to illustrate some key concepts and to make some things clear. So please make sure you're okay with this before continuing with the webinar. And that being said, here is the Nadex risk warning. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicative of future results. Nadex contracts are based on underlying instruments in these asset classes: forex, stock indexes, commodity futures, cryptocurrencies, and economic events. Nadex binary options and spreads can be volatile, and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC. And that being said, let's just get started. Today's webinar is brought to you both by Nadex and Trade with Position. So I would like to kick off with a very brief introduction of those two companies. Of course, you guys do know Nadex. Nadex is a derivatives exchange subject to regulatory oversight by the CFTC, started in 2007, based in Chicago, like just all the big derivative markets, powerhouses and exchanges. All contracts are settled in cash. Big advantage if you come from a futures or options on futures background. You don't have to worry about taking regular delivery in case you have forgotten to close the position early. Nadex contracts are always settled in cash. Makes our life as easy as traders, much easier. And just one more thing to worry about less. Wide range of global markets to trade, all from the comfort of just one single account here. And you have two unique vehicles to trade those markets with: binary options and spreads. Today, we want to learn more about spreads. I'm working for Trade with Position, and Trade with Position has been founded back in the year 2006 by our big trader and founder Nick McDonald. We have been providing education for retail traders and corporate clients since then. Some of our clients, sorry, let me pick up here again. Yeah, We are providing training for international retail clients and corporate clients like exchanges and brokers pretty much since we started back in 2006. Our partnership with Nadex started back in 2011. By now, and all my hiccups, and let me start again, you know, and have realized that I'm not a professional presenter. Very sorry about that, but I'm a professional trader, which means I trade those very same markets that you guys are trading every single day. And this is 100% true for all of my colleagues and myself here at Trade with Position. We're a company run by traders for traders. If you're just getting started with your trading journey, we know where you are because we were there ourselves. And we know what it takes to become a successful trader in the long run. Our approach to trading is a very strategic approach, which means we want to have a trading strategy and we apply those strategies over and over and over again. Which means also that we're looking to trade the markets from a very technical point of view. We like to look at charts. That being said, you have access to the Nadex platform not only from the comfort of your home, on your Mac, on your PC, on your Linux machine, but also if you're on the go. Mobile is becoming more and more important every day, and sure enough, you have access to the Nadex platform also when you're on the go. If you haven't done so, give it a try, check out those apps, and just try also to access the platform using your browser when you're on the go. Makes it much easier to scan the markets and also to stay on top of your positions and actively manage your positions. What is today's agenda? Today's agenda, we want to understand what spreads actually are. I personally feel the binaries are always straightforward. Price is above the strike price or not, that's it. Spreads take one more step. I don't say that spreads are more complicated. It's just a different concept you have to get into to wrap your head around. But don't worry, it's really easy once you understood the basics. And this is what we want to achieve here today. Once we understood what spreads actually are, we want to see those puppies live in action on the live trading platform. We will look at a chart together. We want to understand why this chart might present us with a trading opportunity, a potential trading opportunity, and then how could this potential setup be tradable using spreads. That's always this big chain. I don't just want to trade the markets. I want to trade a setup in those markets. I must see that setup first. And once I have the setup, then is the question, how do I implement that strategy and what instrument is it that I use? Will I use a binary option here at Nadex or will I use a spread? We want to close today's session with how you guys can start trading on Nadex right now. So let's kick it off. Understanding spreads. What is a Nadex spread? It's an options trading strategy simplified and pre-packaged into a single contract. And that spread is defined by two points. One is called the floor and the other one is called the ceiling. And within the floor and the ceiling, within that range, price floats and price moves in sync, pretty much in sync. Not perfectly, but pretty much in sync with what the underlying market is doing. So if I do have a spread on the S&P 500, for example, as long as the S&P 500 is within that range, the price of that spread should be very, very close to what the underlying market, the S&P 500, is currently doing. If price moves above or below the floor and the ceiling, price movement of that spread stops at the floor and the ceiling. But this in just a moment. You can easily buy and sell those Nadex spread contracts to create a long or short positions based on the underlying market. Once again, it's not only a long only position or a short only position. You pick what you like best, and you can even combine those two types of positions if the spread structure makes sense and if all the stars align, to put it that way. Those of you with a little more background in plain vanilla options will realize that the spread that we are talking about is a popular option strategy called a simple vertical spread. A trader buys simultaneously and sells buys an option contract and sells an option contract, and this is what creates this vertical spread. You don't have to worry about that. This is just the background. If you have that knowledge from the plain vanilla options, how you can transfer that knowledge now to Nadex spreads. So let's have a look at a comparison of spreads and binary options. The Nadex spread does have a variable payout on expiration. Remember, the binary is an all or nothing payout structure. If price is above the strike price at expiry, then payout is 100. If it is below the strike price or at the strike price, payout is 0. All or nothing, 0 or 100. With the Nadex spread, it comes down to where within that range. The price of that spread moves with the price move of the underlying, which means if the price of the underlying is just sitting at the floor, payout will be pretty much the floor price. If it's sitting halfway in between the floor and the ceiling, payout will be half. So it's really every point move in that direction is reflected in the payout. We do have, let me grab my laser pointer for a moment here. We do have predetermined floor and ceiling prices. This is already a given when you initiate the transaction. You pick the contract that you like best depending on the floor and ceiling prices. More on that in just a moment. Here, the binary option, you have 0 and 100 levels based on the binary option pricing caps, profit and loss. With the Nadex spread, within the floor ceiling spread, the price is closely related to the underlying market, and time decay is much less significant due to the variable payouts. Price moves along with the price move of the underlying. And this is also why price volatility doesn't play that much of a role. Price volatility near expiration is never higher than volatility of the underlying market. This is quite different to what we can observe when we're trading binary options. Price is based on a combination of market price and time to expiration. Time to expiry plays a much more pronounced role here. All or nothing payout means that time decay is a significant factor here, and price can be very, very volatile near expiration if price is trading near strike. Why is that the case? If you think about it, price is just sitting at the strike price and you have 10 seconds to go. At the strike price means this contract is worth $0 in 10 seconds. If it just ticks up by 1 cent, one tick, it's suddenly in the money. What is the binary contract then worth at that point in time? With 10 seconds to go, it's worth now $100. This shows that the volatility of price of that contract, if it's trading right at the money, this is spiking, this is huge. This is also coming back again from plain vanilla options. This is why gamma of plain vanilla options is so high if it's trading at the money with very little time to go. So takeaway here, spreads usually give us much smoother sailing because all this volatility and time to expiry doesn't have that much of an impact. Sure enough, it does have impact, but not so pronounced. So let's have a look here at the deal ticket, at the order ticket. We're looking here at an example. We're looking at the Wall Street 30, of course, the Dow Jones. And now we do have two things here. We have to note that we are looking at the 17,600 to 18,000 spread. So the 17,600 is what defines the floor price for our spread. And the 18,000 is what defines the ceiling price of our spread. So as long as the Dow Jones is moving within that range, the price of that spread will move along pretty much a few points more or less, but it should be very, very close and just follow along and move along. Here we also have the expiry cycle, when this contract will expire, 4:15 in the afternoon and 4:15, and also the date. Now, the big benefit of trading here at Nadex, you do know your risk exposure up front. So if you want to buy this contract here, and I will show you in just a moment why buying this contract with with the underlying trading at 17,997.8, why buying this contract might be a bad idea. I want to buy this contract. I want to buy 1 unit. My maximum profit is shown up front, and I can see I have the potential now to make $25. Hooray. Not really, because my maximum loss, and this is always shown up front. And this is why I know my risk up front. This is so much better than having to trade other markets with other instruments where I have the risk of markets scapping against me and so on and bad things happening. Here I know my risk exposure perfectly. I can't lose more than that. Can't happen. Why is there so much maximum loss on this contract and so little maximum profit? Well, because I want to buy this contract and price will participate in the move within the range of 17,600 to 18,000, which means the market is already trading pretty close to 18,000, just 25 more points to go. And this is why my maximum profit is just those 25 points until price is actually hitting the 18,000. However, if price decides to drop all the way, I participate on that drop. Forever? No, but until 17,600, until we hit the floor level. So the price of that contract will always be within that 17,600 to 18,000 range. It will never exceed the floor or ceiling price regardless of the movement of the underlying market. It's a perfectly risk-defined position that I do have here. And guys, let me know if you have any questions, just let me know. Those are crucial concepts. This is important, and therefore if you have questions, please don't be shy. So floor and ceiling price scenarios, when the underlying market is trading below the floor or above the ceiling price, the Nadex spread will be trading close to or around its floor or ceiling price. So the market drops. The market is currently trading at 11,500 points. That contract will be priced at around about 12,400 because the price of this contract can't drop below the floor price. That's the limit. It's just sitting there. If you think the market will be going higher, it might be a bad idea to buy this contract, because if we're trading at 11,500 right now, price has to move 900 points so that it's even sitting there, and only after that move, price will start to participate in that move higher. Just a second. MacLee is asking, and thank you very much for that question, because the Nadex spread payout is not all or nothing. Does it make sense for new traders to use the spread more than the binary options? I wouldn't say so. The crucial part, and I will illustrate that on the live platform, is that my risk exposure is spot on. And if you do have good risk control, risk exposure, risk management, it doesn't really matter if you lose a little bit on that contract or if you lose everything on that contract, because your position would have been so small that the outcome would be just the same. But I will illustrate that in just a moment on the platform. But thank you very much for that question. Carlos, thanks for that question also. Just a moment, I will explain how the payout structure there is, what the payout structure works like in just a moment. So we are trading outside of the range. Our market is trading at 13,000 points right now. That spread price won't move. So it will move very little until the underlying market is trading within that range. And then it pretty much mirrors the price move of the underlying. However, within the spread range with time remaining, the Nadex pricing and underlying price tend to have a high correlation. When the underlying is trading more in the middle of the spread range, there will be less correlation as the underlying trades closer to either of the spread strikes or outside of the range. So, selling spreads, reward versus risk. I already illustrated that concept briefly on the previous slides. Let's think about it. I think this market might be going lower. I want to sell this market. I can have a spread now of 12,800, 12,400 is my floor level, that's the ceiling level. If I can sell this market, I sell this market here at 12,700. What is my maximum risk now? Well, I have a short position, so if the market goes against me, it will go up. How much can I lose? I can lose 100 bucks here. This price is going higher, $100, because this is the ceiling level, and after this it can move to 14,000, 15,000, doesn't matter. It caps off here at 12,800. So my maximum risk is just $100. What is my maximum reward? Well, if price happens to drop all the way to hit the floor, my maximum reward would be $300. So I'm going here for a very nice reward to risk ratio of 3:1. Think about selling this market at 12,500, selling that same contract. Well, now I just have a very small potential gain of $100 if the market goes my way. However, I have $300 of risk if the market starts to go against me. So here, selling this contract at 12,500 gives me a very bad 0.33 to 1 reward to risk ratio, which means I must risk $1 for the potential to just make 33 cents. I like this scenario much better. I'm risking $1 for a potential to make up to $3. Just a moment, reading the questions. KM is asking about why I would like to sell that spread. We will talk about technical analysis very briefly later on today. We have other webinars where we can really focus on the technical side and technical analysis. So very brief analysis later on, but sign up for those other webinars, please. By the way, all those webinars are always for free. So there's nothing that I want to sell you guys in any way or form. But thanks for that question, KM. Just reading another question. Carlos, just a moment, I'll be there with you. All right, so same logic applies when buying a spread. If I buy a spread while the market is trading very close to the ceiling level, what is my potential gain if this market is going higher? My potential gain are just $100. What is my risk? All the way until the market hits the floor level. So maximum risk, $300. Maximum reward, just $100. And I'm back again here with my very poor 0.33 to 1 reward to risk ratio. Buying this market, this contract, however, with the underlying market trading at 12,500, I now have just $100 risk for potential gain of $300. Maximum reward to risk ratio, 3:1. So what's the big takeaway here? If I want to buy a market, I'm looking for a spread where I can enter very, very close to the floor of that spread, because then I have very little downside potential and much upside potential. If I want to sell a market, I want to sell this market as close to the ceiling level as possible, because once again, very little risk, much more potential to the downside. And guys, an important takeaway here is it's not a binary option here, which means it's not, I will get, if the trade is a winner, I will make my 3:1 reward to risk ratio. No, it depends on how far that market actually moved. If it moved just 100 points, well, I made just $100 on that trade as a potential gain. If it moved $200, I will have made $200. It's not that automatic. If it's a winner, it's 3:1. That is what happens with the binary option. Spreads have this variable payout structure. Just keep that in mind. So pricing in time and volatility, spreads do not generally have a large time element priced into contract. The contract price should be tracking in line with the underlying, provided it's within the floor or ceiling range. Let's have a look at that in an example here. We're looking here at the Dow Jones, and we're looking at a contract and check what the price of that contract is and was. First, we're starting here at that point in time. Where is the underlying market trading? It's trading here around those 12,630, something like that. And sure enough, that contract here is tracking the underlying market very, very closely. Then time moves on. We're now about 2 hours later, 2.5 hours later. The market is trading at 12,696. Where is the contract trading? It's trading here right at that same level. So you guys can see time has passed. Has time had an effect on the pricing structure? No, not really. More time passes. 1 hour and 15 minutes later. Now it's just 10 minutes to expiry. Where is the market trading? 12,664. And guess what? The contract tracks that price once again. So if you don't want to worry about time decay, nagging away and biting away on your option contract, on your binary contract, then have a look at those spreads. Time decay is much less of an issue here on those contracts. They track the underlying price much closer and much more directly. There are exceptions, however. When is price tracking not in line? Price may not be in line with the underlying when Nadex spread contracts have just opened for trading and have a significant amount of time left to expiry, or spreads are trading close to their floor ceiling with significant time left to expiration. Be prepared to factor in extra price for the time advantage until expiration, and as time passes, the spread contract will gradually get closer to the underlying market price. So, time-defined risk on trades. While time decay is not a significant risk in the pricing of Nadex spread contracts, it is vitally important that you give your trade sufficient time to work out. If we look at that range, that price can move. Always ask yourself, yes, it's nice that I have this 3-to-1 potential reward to risk ratio on that setup, but do I think that it's likely that price actually has enough momentum and has enough going for it so that we will hit this this potential target? Let's not waste our time here trying to explain those things. If we can just have a look at those things. Let's have a look at the S&P 500 here. And very, very briefly, I want to understand what I see on that chart. I want to see a setup first, and only when I see that setup, then do I consider taking a trade. Let's just assume, and I do not suggest that it is, let's just assume that I think this market here might be going higher. Very tough case with this market at that point in time. Let's make it a little bit larger here. And it's really a tough call. Let's just assume we think the market might be going higher. And once again, if you want to learn more about what we see on those charts, how we read price action, and why I think it's a tough call right now, sign up for our other webinars. We have advanced courses for Nadex members where we really illustrate and explain our strategies and how to trade those strategies, both with binaries and with spreads. And during our Market Movers weekly commentary webinar, we can also focus more on the technical analysis part here. So let's just assume I think this market might be going higher. How can we make use of that? Trading spreads. And let's just move that right in here. Try to make it smaller. Where is the market trading right now? It's trading at 2,743 points, roundabout. I'm looking here at my indices spreads, at the US 500 and the daily expiry cycle. And you guys can see that I have those contracts here showing up right now. What is it that I said? If I think that the market is going higher, I probably want to enter as close to the floor level as possible of that spread. So which spreads are available here? I could be looking at the 2,690 to 2,770. Doesn't make much sense. We're trading here at 2,743. We are much closer here to the ceiling level than to the floor. So I wouldn't consider this trade. Let's just assume I'm looking into buying one contract here. You guys can see my maximum profit would be just $245, while my maximum loss is $555. This is not something that I would like to do. And what is my maximum loss scenario? Well, price will move all the way down here to 2,690, something like that. Price will have to drop here in order to give me my maximum loss. Price will have to move all the way to the upside to 2,770 to give me my potential maximum profit. However, bad reward to risk ratio on that trade, so I wouldn't consider that one. If we have a look at this closer, we can see that the market is trading at 2,740. The closest that I can see here is a floor level of 2,730. Now, if I want to buy that contract, I can see that my maximum loss here is right now just 130 points. I would be buying for 2,743, and my floor level is 30. And those are exactly those 13 points or $130, which that contract can suffer if market goes against me. However, my maximum profit is sitting at $270 if price shoots to 2,770. What I like to do is I like to put those levels on my chart. So we're looking here at 2,730. And this is just for illustrating those things. So 2,730. That's the first one. That's my. It's not my stop loss level. It's the point where I'm making maximum loss occurs. And this is my total, or this is my maximum profit scenarios. And I hope you guys can see that we're much closer here to the floor level and to the ceiling level. And so this would make sense if you were, if you considered to go long that market. Now, talking about risk management, I'm looking here at a demo account of $23,000 roundabout. The idea for my trading style is I'm happy to risk 1% of my account on any one given trade. So this means if this trade goes against me, I'm happy to lose 1%. What is 1% of 23,000? Well, it's 230. And so this means if I trade two contracts, I'm risking $260. It's a little bit too much, but just for the sake of demonstration, let's just put it in. So if I place that trade, and I do not suggest that it's a good trade, and I do definitely not suggest that you guys follow me on that trade. I'm just opening that position right now. The order is live. And if this trade doesn't work out at all, the maximum I can lose is I can lose 260 pounds plus commissions. However, if that trade goes all the way for me, happy days. I made about a 2-to-1 potential reward to risk ratio here. Now, what is the payout if price doesn't move at all? This market sits here all the time. How much money will I have lost? And I think, Carlos, that's going towards your question. What is the payout actually? Well, I've opened that trade right now, and let's just modify this order here. And get this trade filled. You currently see the profit and loss, and this is just due to the bid and offer spread. If that market isn't moving at all, I will close that position pretty much for a P&L of 0. So it's not all or nothing, but neither is it if that market isn't going anywhere. Variable payout structure, it didn't move. So therefore, I will have a profit and loss very, very close to 0. So this is, Carlos, I hope that answered that question. If price doesn't move, you will get pretty much roundabout the same thing what you paid for that contract, or you have to pay, short position, you have to pay what you sold that contract for, and that's it. Now, one fun thing here, but before I come to the fun things, guys, any questions here so far? Does it make sense for you guys why the range is important? Why that's the floor, why that's the ceiling, and why it makes sense to enter close to the floor level for a long position and to sell close to the ceiling level for a short position. Romulo, thank you very much for that question. The question was, how much time do we have to enter to open that position? That here you see the time left. So this means this contract here is still trading for 3 hours and 39 minutes. Up until that point, do whatever you like. That's perfectly fine. You can trade this contract all the time until we have expiry. Now, this contract here, also very important, common misconception, this is not a fire and forget trade. I can actively manage that trade, which means I can click in here now. I have two contracts on. I can say I want to sell one contract if that market starts to move in my direction. Now, if I want to sell one contract, for example, if price has moved to 2,750, so right number, wrong field, sorry about that. We're going here for 1 and putting that number there. So idea is here, why not put in a take profit order? I can just say if that market is shooting 13 points higher, I want to close one of those contracts and already lock in some of those profits. So I can place that order now. This order is a limit order because the market price isn't there, but just in case price shoots up and hits my my limit price, that order will be executed and I will have closed a part of my position. I will already have locked in some of those potential profits. You can actively manage those positions. Very huge benefit. What I always like to do in trading Nadex contracts, it's you can manage your trade. Take some money off the table. If you have already, I do not have to worry about stop losses because my position sizing was done in such a way that my maximum risk is perfectly in line with my exposure and in line with my total account size. So no need for a stop loss. You can do one if you want to. The approach is just the same, but I can actively manage my position going forward. And guys, one more thing, a little bit more advanced right now. Remember 2,730, that's the point where we say that's the floor level for this contract. If the market was trading right now at 2,730 points, what we could also do, we cannot do now, but it was much sweeter when I prepared for today's webinar, we can be looking at this contract here. The special thing about this contract would be that the market, what was the floor level of the position that we have already on, is now the ceiling level of this contract. So if you think, Philip, I don't agree at all. I think this market is going much lower. The upper shadow is much more bearish to me, and we haven't dug ourselves out of the hole yet. This market is going lower. Perfectly fine. The idea could be to say, okay, I want to sell this contract, and it's a little bit, the underlying market is trading a little bit above that range of that contract, but we're quite close. And the idea could be to say, all right, I want to sell one contract here. What's my maximum loss? My maximum loss is just 19 bucks. Because why? Because currently we are trading above the range. This is, does it track the price? Does it track price of the underlying perfectly? No, because we are outside of the range. If that contract settles, it will settle for 2,730. And this distance here, this is just time value now. It's very minuscule. It doesn't play a big role. And that's pretty much it. So an idea could be to buy the contract that we already have and to sell the contract that we have here. If you think price is moving in either direction, it's shooting much higher or it will be shooting much lower, initiating a position where you say, I'm selling the ceiling level of one contract, which happens to be the floor level of another contract that I intend to buy, then this is spot on. And if the market moves a big amount, then this strategy will make you money. If the market doesn't move, you will have lost probably on both contracts. But again, proper risk management, risk exposure is what makes the risk there definitely A, always well defined, and B, containable. Scott is asking about settlement fees. And Scott, honestly, I don't have the precise answer for that. So I'll leave that question to be answered by the good guys from Nadex, or to follow up with you on that question just after the webinar. Before I give you any wrong answers here, sorry about that, I'd rather skip here. All right, guys. So once again, before we wrap this up, quick question. Did everything that I tell you today make sense? Do you understand what a spread is? When you want to buy the spread and when you want to sell the spread, you want to buy it when the market is going higher, or when you think the market might be going higher, and you want to sell that spread if you want to initiate a short position, if you think the market is going lower. Next thing, once you have that basic idea about what the market might be doing, next thing is I want to pick the right contract for me. And picking the right contract is how much time does this contract have, and how quickly is the market moving. Talking about time of this contract, let's just dig a little bit deeper here and let's have a look at the 15-minute chart. Now, the question is, looking at this 15-minute chart, and we just have, guys, don't be confused by the time here. That's obviously my my German time that we're seeing here. Do you think that within the time that this contract still has, do you think that it's likely the price will hit the floor level or hit the ceiling level, depending on your position? That's the big question. You want to give this contract enough time to move in that direction, and this is when you pick the different expiry cycles here. In this example here, I went for the longest expiry. I wanted to give my trade the longest time to work out. And yeah, that was the reason for that. But you pick the expiry cycle, and next thing you pick if it's either if you want to enter at the floor or the ceiling level. It's not always perfect that you can get the perfect floor or the perfect ceiling, but you want to see that you have a favorable reward to risk ratio on that trade setup. Your style of trading might be completely different. You might go for those small rewards and the big risks. I wouldn't understand why, but that's just me. You pick what you like best and what works for you. For me, a decent reward to risk ratio always makes a lot of sense here. All right, so which contract, which market, which expiry cycle? Guys, are there any questions left at this point? Scott, thank you very much for the feedback. Really appreciate it. KM, thank you very much. All right, guys, unless there are more questions, Romulo is asking about the charting package that I've been using here. We have to differentiate here, guys. Romulo mentioned that can we use any other trading platform besides TradingView. This is just my preference for charting here on this webinar. It has nothing to do at all with Nadex. With Nadex, that here is the Nadex platform, and you can use whatever charting package that you like. And if you say, wait a minute, I don't have a charting package, no problem at all. You have here those small chart icons. If I just click on one of those chart icons, you can see the charts popping up here right away. And while those are not perfect charts, far from it, they are awesome charts for being completely for free and for being included here. You can go for different time frames here. Here we're looking for a 5-minute chart, 15-minute chart. You can go for candlesticks or other types of charts. You can add some of those basic indicators. Absolutely perfect if you don't have any charting at all. So just because I used that other charting package here does not mean that you have to do it. Nadex here also is pretty much self-contained. You have everything that you need to get started here on that platform. So instead of investing in any charting package from the get-go, rather fund your account and get started here and practice with a demo account here on Nadex. Romeo, thank you very much for that question and reminding me of clarifying that. All right, guys, so start trading with Nadex today. I hope you have seen how easy it is to place those spreads. Quick recap: spreads providers with a variable payout with minimal time decay. Selecting the right contract allows capped risk with significant upside potential, 2-to-1, 3-to-1, depends on the contract and the market price of the underlying. Low minimum tick size of $1 offers another advantage over the underlying futures market. You can really trade small. Here it makes sense to get started with a very small trading account and still be able to apply proper risk management, much, much better than shooting for futures or stocks, for example. You can trade global indices, spot FX, and commodity futures from one single account. This was now the big daddy of them all, the S&P 500. You can trade the German stock market, the DAX. You can have access to commodity markets. You have a very good broad range of markets available for trading here at Nadex. Trading with Nadex is DMA, direct market access. Nadex is the exchange. There is never some kind of broker sitting in between. You are trading at the exchange. You're a member of the exchange. So guys, if you haven't signed up for a demo account, please do so. Get your feet wet. Try everything on your own, completely risk-free with the demo account. One big benefit, that slide still says it's a 14-day demo account. Good news, that 14-day limit has been lifted. You can practice for as long as you want to. You see different ways to be in touch with the good guys at Nadex here on that slide. And K&M is asking about a recording of that presentation. My understanding is that the recording will be shared later on. But if that's not the case, once again, the good guys from Nadex will be in touch with you there. All right, guys. If there are any further questions, then thank you very much for attending and the great questions and the great feedback. Really appreciate it. Sign up for our other webinars, and yeah, I'm really looking forward to welcoming you guys during our next presentations. And then we can also focus much more, of course, on technical analysis and how to read those charts and how to arrive at possible trading setups and trading decisions. Thank you very much once again. And now to all of you, have a great trading day. Take care. Catch you next time. Thanks again, and bye-bye.